Good morning. Welcome, everyone. And we'll get started here.
Hi, I'm Ken Schaefer. I'm a senior tax manager at Maynard. I typically work with small businesses and mid-sized businesses, individuals, and employee benefit plans. Cole, would you like to introduce yourself?
Good morning, everyone. My name is Cole Williams. I work I'm a manager in the tax department here, and like Ken, I also work with a lot of our small and mid-sized businesses, focusing primarily lately on affordable housing and our telecommunications industries. Other than that, we'll get on to the agenda here, kind of touch base on what we're going to cover today. All righty, so moving into today's agenda, we're going to cover some of the recent legislation that was passed the last year or so, revolving around the CARES Act and the pandemic, as well as the American Rescue Plan Act. And then we'll touch base on some of the planning opportunities surrounding those, and then wrap up with going over the most recent Infrastructure Investment Act, as well as the Build Back Better Act that's still kind of getting debated, and some of the tax implications that those entail. So with that, I'm going to toss it back to Ken here. He's going to talk about the PPP loans and some of the other CARES Act provisions.
All right, let's get started. This is, when it first came out, it's called the Paycheck Protection Program. It's more commonly known today as the PPP loans. And what this was is these were SBA-backed loans to help businesses keep their workforce employed during the COVID-19 crisis. So initially the loans repayments were set up for either 2 years, and then it was extended to 5 years if you got the loan after June 5th of 2020. So if the loan wasn't forgiven, you had until the forgiveness application was processed, or potentially 10 months after your 24-week coverage period ended. So, and to qualify for the full forgiveness, there were certain expenses that you could use these for, such as payroll, mortgage, rent, and utilities. So after you applied for the forgiveness, you had to wait for your loan forgiveness letter before you knew for sure that it was going to be forgiven. So, and one of the benefits of the PPP program is the expenses, they remain deductible. So one of the concerns regarding this, it was the time treatment. There really wasn't any clear guidance as to when you had to recognize the forgiveness of debt, but you had to at least wait till you got the letter. So it was hard to match the expenses. Typically, a lot of businesses would incur the expenses in 2020 and got the loan forgiveness and letter in 2021. So there's created a lot of uncertainty. So, and one of the benefits of this loan, if you were a pass-through entity, while the PPP loan was forgiven, it was non-taxable income. But one of the benefits was it would create basis for you. So if you're a pass-through partnership or a S Corp, it would create basis for you, which may allow you to take losses. So if you have questions for this, well, now we are pretty much beyond the 24-week period that these loans were for. The funding for these SBA loans ran out in early May, so the 24 window is pretty much over. So you probably would have incurred all your expenses, and if you haven't already, now would be the time to be applying for the loan forgiveness. And if that's an area you need assistance with, Maynard has quite a few people that were dedicated to helping people with the PPP loan program. And if you also need assistance, determine what period to recognize the income, we can also assist you there. And one thing with regards to the PPP program is that, at the state level, while the federal government does not recognize this as taxable income and lets you still deduct the expenses, a lot of the states, some of the states don't follow that. Luckily, Michigan is one of the states that does follow the federal in this case, but if you're a business that operates in multiple states, you need to look at on state by state case what their rules are. So now I'll throw it back to Cole, let you talk about employee retention credit. And Cole, make sure you unmute.
Yeah, I got it this time. A little bit early. But yeah, so kind of along the same lines as the PPP loans, the CARES Act, in trying to help the employers and businesses navigate and deal with the implications of the pandemic, they set up the employee retention tax credit. And so what that is it's a credit that became available in March of 2020. It allowed eligible employers a credit to offset their employment taxes. And then they could also apply for a refund of any credit amount that exceeded their employment taxes. So when the pandemic kept going, when the pandemic was kind of extended and it's droned on into 2020, the American Rescue Plan Act basically extended that or expanded the credit from 2020 through 2021. It was initially supposed to be through December 31st of 2021, but with the infrastructure bill that just got passed, looking through that, it seems like they clawed some of that back. So it's available to help companies out in 2021 still, but now it's only through September 31st of 2021. So all of the credit was extended through this year or through the end of this year. There are some differences with the eligibility requirements, as well as the amount of credit or how the credit's calculated for the 2 years. So if we're looking at the 2020 credit, you kind of had basically two main eligibility requirements that had to be met. The first one of those being a suspension of business due to a government order, due to an emergency ordered by the government. And that could be partial or full suspension. So a partial suspension, meaning basically for restaurants, you could still have takeout operating, but if you couldn't have people come into the actual restaurant or similar with drive-throughs, other businesses, there's some more stringent kind of guidance the IRS came out revolving around, I think it was 10% of operations or activity that was hindered. But the big piece of it is a partial or full suspension. The other side of it is you could also, if you didn't have a full suspension of activity or partial suspension, you could have a reduction of 50% or more when comparing gross receipts from 2020 to 2019. And that was done on a quarterly basis. So you would start out with looking at the first quarter of 2021 or 2020 rather to the first quarter of 2019. And then, if it was greater than a 50% or more, you're eligible. And then you were only eligible for the quarters up until, I think it was 80%. So after gross receipts exceed 80% for the same calendar quarter, that following quarter, then you're no longer eligible. But as long as the reduction is there, then the wages as well as qualified health care can be taken for the credit, and that's up to, for 2020, that was up to $10,000 per employee annually. So, $10,000 per employee, and that was done annually. So at 50%, you had a $50,000 max per employee, and it was for wages because that credit was kind of started in March. It was only wages from March 13th, 2020 through December 31st of 2020. And so again, with things kind of continuing on, the American Rescue Plan Act luckily extended that credit or the availability for that. So the credit was extended through 2021. The eligibility was a little bit different. So the partial or full suspension requirement, that was the same. The second piece of the reduction is where things differ a little bit. And so for 2021, instead of being a 50% reduction, it was, I believe, I think it went down to, sorry, find percentages here. There's a 20%. And so, and then also the amount of the credit was increased. And so instead of, if you were eligible, looking at the quarter to quarter basis, it was no longer just 50% of your qualified wages and health plan expenses, but it became 70%. So you had a $10,000 per employee per quarter. And so then looking at that max, you have $28,000 per employee that could qualify. And it wasn't just March through December. Now it's going to be, well, it was supposed to be January through December, but with the new bill coming out, it's now January through September wages. And so Ken was talking about the PPP funds, and initially you weren't going to be able to take both the PPP and the ERTC, or the Employee Retention Tax Credit. They since changed that. The biggest piece of it is if you use wages to qualify for the PPP loans, you can't then use those same wages to generate the Employee Retention Tax Credit. So there's a restriction there that they can't kind of be counted for both. There's a couple other tests that you got to, not just the eligibility tests, but when looking at how the credit's calculated, there's some threshold tests that also differ from 2020 to 2021. But essentially, the threshold test for 2020 was 100 employees, and then in 2021 is 500. Now, not to say that if you have over 100 employees, you're no longer eligible for the credit, but the amount of credit you're going to qualify for is going to be greatly reduced. And so kind of similar to the PPP stuff, we when all these credits and acts started getting rolled out, we set up a team at Maynard. So we have a number of people that are really well versed in this. And so if you have any questions on whether or not you're eligible, or if you think you may be eligible and want help calculating the credit, figuring out how to take it, we can certainly sit down with you and go over that. But kind of moving past some of the eligibility and everything, when we're looking at how to actually claim the credit, it's going to be done by filing your 941s. And so you'll file an amended 941 for 2020 or the 2021 quarters that you've already filed for. And you have 3 years from the filing date to do that. So there's statute of limitations there. As long as you file those amended 941s within 3 years of your initial filing, or 2 years from when 2 years from the date that you paid the taxes, you can still get that credit provided you're eligible. And so again, kind of similar to the PPP stuff, initially when this all kind of came down, there was a lot of questions of, okay, so if we have to file amended 941s, when do we claim this credit on the tax return? Is it taxable? How's it going to be treated? And so for a while there, and it differed whether or not you were a cash basis employee or employer versus an accrual basis. I think it was around August, the IRS kind of finally came out with some loose guidance on that, and the position they're taking is that the amount of refund that you get back from filing those amended 941s, that's going to be taxable, but instead of recognizing it as gross revenue, what you'll do is you'll offset the wage expense in the year that the wages, that the credit applied to the wages. So say you were filing a amended 941 for 2020, you're trying to get the credit for that year, then you're also going to have an amended tax return, whether you're a C Corp, a partnership, you're going to have an amended tax return as well, because you've got to offset the wages in that year. So that's going to kind of add a little bit of complexity there, but it'll be the same thing. You'll have 3 years from the date of from the filing deadline plus extensions. So if you were a corporation, you had a April filing deadline and you filed extensions to get you through October, then you'll have 3 years from October to file that amended business tax return. Now, the tricky part with a lot of this and why it's beneficial to kind of sit down or look into some of this planning before you just apply for the credit is if you're a partnership and you've got a 199A or a QBI deduction, it can impact that. It can also impact if you're having to amend prior year returns, depending on any AMT credits that you had. It can kind of end up coming into that. Now, with that being said, if your 199A deduction is something that's going to get impacted, while it's going to create some complexities with the filing of the amended return, it's almost always going to be advantageous to take the credit because it's going to be a dollar for dollar reduction in tax, whereas the 199A deduction that was rolled out with the Tax Cuts and Jobs Act in 2017, that's just 20%, loosely 20% of the tax that you owe. So the credit's almost always going to be more advantageous, being that it's a dollar for dollar reduction. All right, just making sure there's not anything I glanced over there, but I think we'll move on from all those acronyms with the ERTC and the PPP and the millions of acts, but we'll move kind of on to some of the other federal tax considerations. So with the CARES Act, as well as the American Rescue Act, obviously the PPP and the ERTC were some of the larger bills or acts that had tax implications because, again, it was a large credit that was out there, as well as loans that could be forgiven. So those were kind of two of the more crucial pieces, but there's also some other provisions in the CARES Act that do have tax planning implications and can ultimately end up helping you out if you have time or to look into them. So the first one we'll go over is the NOL carryback, and as well as the carry forward. So in 2017, with that huge tax overhaul, there was basically the NOL carryback that was allowed beforehand, that was changed, and then the ability to carry those back was removed. So the overall percentage of net income, so not only was that removed, but also before 2017 got passed, you could use your NOL to offset 100% of your taxable net income. That was also changed to be only able to be offset by 80%. So the CARES Act restored the 5-year NOL carryback for losses arising in years after 2017, but before 2020. So you can still elect to forego the carryback. However, a lot of times it's going to be more advantageous because if you can carry that back, the tax rates were higher. So, it's still available to elect to forego it. And the election is done on your 2019 and 2020 returns. You can retroactively elect out. You don't have to go back and amend those prior year returns just to put that election in there. It can be done. Can be done retroactively. The biggest piece of the NOL stuff is going to be looking, how it's going to impact other items. So with you being able to, the 100% that was reinstated as part of the CARES Act, that's only going to be up until basically through the 2020 tax year. And then once 2021 hits, that's going to it's going to basically sunset back to the 80% rules. So if you have, already have high NOLs that you don't think you're going to be able to use, it's going to be beneficial to look into bonus depreciation and potentially not creating larger NOLs that, you would be able to use 100% of the depreciation expense that you carried forward. However, if you create the NOL by taking bonus depreciation or Section 179, you're going to be limited. You can carry forward the NOL indefinitely, but it's going to kind of hamper how much you're able to take over the next few years. Alrighty. And so with doing the NOL carryback, what comes into play with that is you'll file a Form 1139, which the last basically eligible year that we could still do that through December of this year would be for 2020. So you have, in order to file that 1139, you've got 12 months after the start of the year after the end of the year for the tax year that you're claiming the carryback for. So if you're trying to carry back a loss or an NOL that was generated in 2020, you're going to have until 12/31 of 2021. So roughly a month and a half left. The other way that you can carry that back is through filing amended returns. The tricky part with that is with the 1139s, the IRS is required. I think it's within whether or not they'll abide by the requirement with how understaffed they are right now. They've got 90 days. So if you're able to file the 1139, obviously that's going to be a lot quicker to get any refund of taxes you had paid in for those years that you're able to offset and carry that NOL back. Versus filing the amended return. Sometimes it can just take longer. So it's still an option. But again, you only have, I think it's the statute of limitations being 3 years. So it does time out after a while, but if you don't get it in the 12-month period, it's not a done deal. You can still carry those NOLs back. It just gets a little bit more cumbersome to get your money back from the IRS. It's going to take a little bit longer. Another piece of the CARES Act that a lot of people are taking advantage of in 2020, and now it's again with the American Rescue Act, trying to keep track of all those acronyms, sorry. But with the American Rescue Act also got extended in 2021, so a lot of people are also taking advantage of it this year, is the increased charitable contribution limits. So after the Tax Cuts and Jobs Act in 2017, the max amount of charitable contributions that corporations could take was 10% of their net income. That got jumped all the way up to 25% in 2020 and then in 2021. And then for individuals, it was similar. Obviously, the amount that they're able to take was increased. So individuals can offset 100% of their income for 2020 and 2021. And then the other piece of it is, even if you still take the standard deduction, whereas in the past, that would disqualify you from being able to, recognize or deduct any of your charitable contributions. For 2020 and 2021, you can still take an above the line deduction. For individuals, it's going to be $300, and then for joint returns, $600. So what that's created or given us an opportunity to do is what's called bunching strategies. So if you've got the cash flow available, what we can try to do is move some of those charitable contributions that either you would be looking to make in 2022, or just kind of condensing those contributions in order to take advantage of the fact that if you're a corporation, or if you're filing a corporation return 1120, you can offset a lot more of your net income because you're not going to get cut off quite as early. And then same thing with the individuals. The other strategy that's available is with IRAs, because in order to offset 100% as well as get the increased limit, it's got to be cash contributions. So what that means is you can't contribute stock, you can't contribute services. However, if, in the past you've used IRA distributions to donate, that's still going to qualify. And if you're over the age of 59 and a half and you've got IRA distributions, not from a Roth IRA, but they'll be taxable, you can offset 100% of your income. So if you do have the cash flow and the ability to do it, you could set aside all that, utilize the bunching strategy and take advantage of the increased contribution limits that we have. And so the last piece of it, which is, coming into play a little bit less, is the refundable child tax credit. So what the IRS essentially is doing is not really changing up a whole lot with the eligibility or anything on the credit. They're just allowing you to get some of the payments in advance to help people out with, bills and just kind of navigating the financial hardships that they experienced from the pandemic. So it's either $300 or $250 per month payment is going to come in advance. And it's going to reduce the credit when you file your return. So it's not like you're getting that in addition to what your credit would be. You're just going to get it in advance. You could opt out of it through July. At this point, if they've been sending the payments, it's something you're going to have to watch out for, because on your 2021 return, you're going to have they're going to be sending out a form. I think it's in January of 2022, telling you how much they sent you in advance, what the remaining amount is that you could take on your return. And we're just going to have to watch out for that so we don't overclaim it and then you end up getting notices down the road just because you weren't aware that the IRS was mailing checks that either you didn't get or depositing, using the direct deposit account that you've had on file in the past. And just kind of slipped under the radar because it is still fairly small amounts. So the last piece that I'll touch base real quick before shifting back over to Ken here is just the stimulus payments. So I'm sure a lot of you are aware with the 2020 return, there was the first and second round of stimulus payments. And if you didn't receive the checks or didn't receive the payments, we were able to claim those on your return. It's going to be the same thing for 2021. So if you didn't receive the third stimulus payment, which should have been, I think, single for, roughly $1,400 if you qualified for the full amount, or $2,800 if you were married filing jointly, you won't be able to claim that on the return. So you'll just want to watch out for or keep track of this amount and make sure that you circle back with your tax advisor before filing the return, because they're not going to, if it was sent to you based on your 2020 return requirements and say you had much more income in 2021, they're not going to make you pay a portion of that back. That's the nice part. What they're really looking for is if you had a larger income amount or a different income picture in 2021 or 2020 versus 2021, where you didn't get the full amount that you truly qualified for, they will reconcile that for you. So it's not anything they're going to make you pay back. So it's just something to kind of keep an eye out for and make sure that we get you the full stimulus payments when we file the return. I will kick it back to you, Ken. Oh, maybe not actually. What do we got here?
No, I think this one's still you.
Yeah, yep, it is. All right, I'm going to continue droning on here. A lot of this is, not as pertinent as the federal stuff, but we do have, obviously with the CARES Act and some of those other ones coming out, it's not only affecting your federal tax picture, but there's some implications as far as your state and local taxes. The biggest piece of that being, I'm sure as kind of everyone's seen, things went to a remote work environment when the pandemic hit, and a lot of companies and employees are realizing that either the situation works a little bit better for them or the company's able to save some money by not having quite as much office space and overhead. So we've got employees that are working in, locations or kind of the blurred lines of where they work and live and everything. That's all changing. So employees are working in cities and jurisdictions that employers haven't haven't operated in the past. And what this is doing is it's kind of creating a bit of a tracking, I won't say issue, but it's requiring a lot of additional tracking and reporting in order to figure out potentially additional out-of-state filings or nexus concerns where the employer now has to remit either withholding for an employee that is working in a different state, different city, different location, or other compliance requirements. That could even create nexus and require the employer to file an income tax return. So that's kind of worst case. I won't say worst case scenario, but the biggest thing that needs to be looked out for or tracked is just making sure that we're still compliant with all the jurisdictions that the employer might now be subject to, because especially with the states realizing that they potentially can kind of claw back some more income or pull income into their jurisdictions and generate some revenue. They're looking much more closely, at where the employer and the employee is working from, and whether or not they need to be filing returns there. So that's definitely something we need to be looking out for, because they've got, it could be sales tax, gross receipts tax, as well as, whether or not you have to apportion income to that state because it's created nexus. Each jurisdiction kind of has a different set of rules, different requirements. I know one of the few that was pretty common last year was Lansing. So I think it was Lansing and even East Lansing, with Michigan State being close by us, there's a lot of, I think, faculty and teachers that were employees at Michigan State and all of a sudden had to go work remote, and they didn't live in Lansing or East Lansing. So a portion of their wages were no longer, subject to those taxes. They didn't have to have withholding. However, Lansing was pretty stringent in the sense that, they weren't just going to take your word for it. You had to submit an actual letter from your employer stating, the time you worked in Lansing versus the time you worked, wherever else you might have been living or residing, where your home office was, and then allocating your income, using those percentages or using those hours that they were breaking up. So, I think we're going to see probably with more work from home, I think we're probably going to see more states and jurisdictions that might require this. Hopefully not, but again, something to look out for. That way we're kind of out in front of it and not trying to, have the employer generate something last minute, or having them rush something that, potentially generates notices, or the city or the jurisdiction will just essentially state that all of your income was subject to tax there. And then we've got to try to fight behind and work on clearing notices and correspondence from states or cities. So, all righty. I think, another piece of this is going to be, the state tax bills are kind of all changing. They're looking at nexus. They're looking at kind of what's going on. I know at one point with the CARES Act that they were trying to, again, help people out with getting more deductions and everything. So at one point there was a bill out there that was going to allow, a greater percentage of state and local taxes to be deducted by kind of circumventing the itemized deduction limit of $10,000 on the individual returns. So the proposed bill that was out there was going to allow you, if you agreed to pay, if it was a pass-through entity and you agreed to pay or deduct taxes on behalf of the partners, they were going to allow you to deduct the property taxes on the business return, which doesn't have a $10,000 cap. And it was, depending on the type of business, of course. And so that was something that we thought was going to go through and give us a little bit more leeway there. It ended up getting vetoed in July of 2020, but again, something to keep an eye out for, because I think, the legislature is considering options, as well as working on trying to get something signed into 2022 to give people a little bit more of a break on their deductions and everything. So something to circle back on, or just keep an eye on moving forward when we're looking into planning. And now I think this next one is you, Ken.
All right, let's touch on tax enforcement. We've seen quite a bit of change there with the COVID. Basically, the IRS was shut down for a period of time. This created a huge backlog and getting returns and notices processed. So as a result, we're seeing more notices, because what we would do is the client would receive a notice that we'd send in a response, but there was nobody there to really process that response. So, and then the computer system would kick out the next notice. So it just created a lot more stress on the part of clients. And to contact the IRS, there's plenty of times they would say they can't take your call due to call volumes, so please try again at a later time. So it's hard to get through to them to talk to about a notice as well. But another potential option would be, you could do an in-person appointment if you're able to get that done. So going forward, what we're going to anticipate, I know in the Build Back Better program, one of the provisions, they were hoping to add up to 87,000 additional IRS agents over the next decade. Whether or not that's where it ends up, or if that's one of the things scaled back in the bill, we don't know yet. It's kind of a wait and see. But if they do that, I would anticipate, more audits potentially. And so it's important that you do, take care of your records. Good record keeping is going to be your best defense against any notice, so that you can document what you claimed, your deductions. So to have good control is going to be very important. So, because if you don't have the proper documentation, certain expenses can be disallowed. So it's very important to keep your documentation in order. And as far as things, if you're dealing with the IRS and you don't agree with how it's going, there is always an option to appeals, take your case to appeals. So that's something we've helped many clients with. So what's happening with estate planning? Currently, an individual has a personal exemption of 11.7 million. Some of these build back program, they're looking to scale that back. What it's going to be, it's hard to say. Proposed number was 6.2 million. Will it stay there? Will it change? I don't know. But one of the things, if they don't do anything, there is a sunset provision for this increase. So then 2025, without any legislation change, it's going to drop back to 5 million per individual. So it's important to have your planning in order, so that you can accommodate these changes. And if you're looking to gift, through 2021, you're still able to gift up to 15,000 to an individual without having to create a filing requirement. For 2022, that's projected to go up to 16,000 per individual. So, and if you happen to gift more than that amount, you can tap into your lifetime exclusion, so that you're not creating a taxable event. So and another thing, that may be advantageous is what you gift. Say you have a child that's old enough and you want to gift them appreciated stock. That's because on your return, you'd have to pay, capital gains, and you might be in the higher tax bracket, so you could pay up to 20% gains. But if your child, be in a lower bracket, maybe they'd fall under a lower, they'd be able to pay 0% or 10% or 15% gain on that. But one of the considerations is the kiddie tax. If you have a child under 18, that's going to kick in the kiddie tax, or if you have a full-time student between 19 and 24, they would also have to consider the impact of the kiddie tax. And as far as succession planning, lots of baby boomers continue to retire. Lots of them, and that number with COVID just seems to be accelerating. So, proper planning is very important, to plan early, as things always change. So what you had in place currently, may not be the same thing a year from now. You have to look at what the tax laws are, and, situations change. So it's important to plan and to keep monitoring that plan. All right. So next we'll talk about some tax planning ideas. All right, one thing that's been changed, or one of the provisions that's come out, is meals. Previously were only 50% deductible. So to assist restaurants and businesses who have been hit the hardest due to COVID, for 20 and 21, if you purchase a meal at a restaurant, for a client, you can take 100% deduction for that. And that's only for 20 and 21. And it has to be a meal at a restaurant. It can't be a purchase of food. Entertainment is still non-deductible. Otherwise, meals are still capped at 50%. And then depreciation, it creates an opportunity. Cole touched on a little bit. What we have is basically a couple options when a business adds a new asset. You have bonus depreciation, you have Section 179. One of the differences between those is bonus depreciation, you can expense an item if it's got a life of 20 years or less, and it can create a loss or can create an NOL, which was beneficial in the last couple of years when we had the 5-year carryback. But that 5-year carryback has gone away for 2021. Now we have to look at carrying forward. Versus Section 179, when making this election to expense a fixed asset, it cannot create a loss. It can take your taxable income down to zero, but it cannot create a loss. So what you may want to consider is, if you bought a large amount of equipment, if you take Section 179, you can zero out the current year income and then carry forward the remainder. It'd be disallowed Section 179. It wouldn't be lost deduction, but just be carried forward. So if you're anticipating a good year in 2022, it can reduce your income next year. Whereas by comparison, a bonus depreciation, if you create an NOL, it can only offset up to 80% of 2022's income. Whereas a Section 179 deduction disallowed this year carried into 2022, you could use it to almost zero. You could use it to zero out income again. And one thing that's always a subject or a topic is vehicles. It's not a one size fits all. You have to look at what the vehicle is. Because basically you have cars, you have trucks, you have mid-sized trucks, you have full-size trucks, you have vans, SUVs. So they're not all depreciated the same way. So for a vehicle, let's see, a vehicle for the first year is going to be depreciated at for 2021 at $10,200. Now, if you elect to take bonus depreciation, you could take up to $18,200. By comparison, an SUV a first year, you could take under with Section 179, you could expense up to $26,200. And just for comparison purposes, trucks, which are basically your full-size truck, you have to look at the gross vehicle weight rating. If it has a 6,000 or more weight rating, then it's exempt from these lower depreciation limits, and we could potentially, under Section 179 or bonus depreciation, fully depreciate that asset. So it's important to look at those on a vehicle by vehicle basis. Now, what's going to happen with the NOLs and beyond? Well, for 2021, they get carried forward. It's going to be subject to the 80% limit of income. And then, so you have to watch out for safe harbors because you can't zero out next year's income with your NOL. So you got to make sure you pay your safe harbor estimates. And with many things, not all states are on board with what the federal government's doing. So you have to look at each state. For depreciation, states have different rules. They all didn't adopt the federal depreciation rules, and same with the NOLs. So you have to look at each state on a basis, state by state basis. And another opportunity that we have now is what method of accounting? Because what they've done now is they've raised the cap that requires you to use the accrual basis of accounting to 26 million. So if you're a business, you want to switch over to cash basis, you have an opportunity to do that. And when does that make sense? If you have a business that tends to have slow payers, so your accounts receivable is high, you're paying, basically you're recognizing that as in your sales and your income statement when you record that account receivable. So on a cash basis, you wouldn't recognize that income until you actually receive the cash. But so there could be a benefit there, and it would require to file a form 3115 for change of accounting method. But if you're a business that still maintains inventory, you'd still need to do that. Research and development, a change. Previously to this point, we've been taking, if you've a business that claims an R&D credit, you either take a reduced credit and not adjust your expenses, or therefore still deduct them, or you take the full credit and reduce your expenses by the amount of the credit claim. But starting with 2022, that's going to change. You're going to be required to capitalize and amortize over 5 or 15 years, depending on the source of the R&D expense. So opportunity or planning opportunity there, if you have R&D expenses that you traditionally take, can you pull any of those into 2021 so you don't have to capitalize those? That's an important thing to keep in consideration. Another item is the corporate tax rate. Currently, it's at 21%. It looks like it's probably going to stay there, but I know in the Build Back Better program, there were comments about changing that, maybe up to 28% or something at 26%. That's an item we're not going to know until the actual bill gets passed, and it's hard to say when that will happen. So it's important to be able to plan around the legislation.
Definitely. I think you just touched on it, Ken. The Build Back Better Act, I think initially was slotted. That bill has been changed a million times in trying to get a version that they think will get passed. I think it started at a $3.5 trillion bill. It's down to 1.75 now. And a majority of those changes that, kind of came out of there were initially they were wanting to up the corporate rate from 21% to 26.5. That looks to be done away with now because they weren't getting enough traction with people that were willing to sign on to it with it increasing that. And same thing with the individual rates. They're wanting to increase those back up to 39.5%. So they're not going to increase the actual income tax rates for the individuals. However, nothing's been passed yet. So with that being said, there's still a lot that can change. There's, nothing set in stone. And I think it's probably indicative or, probably telling of how things are going to go moving forward. I don't think we're going to see tax rates decrease. I think if anything, they're unlikely to go down. They're probably going to go up, and we're going to see other, various other changes that are still going to have an effect and still going to raise the overall tax liability moving forward. So I think, we just had the Infrastructure Investment and Jobs Act passed, and And the bulk of that bill was aimed at, large investments and infrastructure projects across the country. But there were a few tax provisions. The majority of the provisions are, we're going to have to wait and see if the Build Back Better Act gets passed, and what's involved in there. The most significant piece with the Infrastructure Act was what I kind of touched on earlier, is the employee retention credit was supposed to go from January of 2021 through December of 2021, and that got clawed back. And so the time frame for that's now through September. I think the consensus or the thought behind that is essentially they've got to start to try to pay for some of these $1 trillion bills through something. So clawing back a little bit of that credit was a way to go about it. But as far as, some of the other pieces in the Build Back Better Act that we're kind of keeping an eye on is it does look like I said, as far as the actual, brass tacks corporate rate, it doesn't look like that's going to go up with this one. Fingers crossed, so to speak, but there are a number of other items that are going to potentially raise the overall tax liability. We've got potentially a corporate minimum tax that they're looking at tacking on, which is going to be 15% of book income. The threshold of that book income that they keep throwing out there is changing. I've read 100 million or 1 billion. That keeps flipping around. So we'll have to kind of stay tuned there, but that's going to, again, the overall rate's not increasing, but if they do have that 15% kind of tacked on, there are going to be some companies that are going to see their liabilities go up. There's also a surcharge or a billionaire tax that looks like they're going to tack on, which is going to be, I think looking at like 3% of, it's going to be like a 3% surcharge on modified AGI or, your adjusted gross income less your investment expense for people that have over 10 million. And then as far as the pass-through taxes go, they've thrown out a number of things there. Again, initially they were trying to kind of hit the 199A or the QBI deduction, that 20% deduction. They were trying to lower the overall amount there. The most recent version of the bill that I've seen, I think, was drafted on the 5th or the 6th. No, nothing's gone through yet, but it looks like they've pulled that back. The biggest piece that's going to affect the pass-through potentially is they're wanting to put a net investment income tax on your active businesses. So that's going to be, I think, looking at like a 3.8% there. And then they're also going to make permanent the pass-through loss limitations. So you're not going to be able to offset, all of your income through pass-through losses, which could hurt at the end of the day. The piece that was interesting was something I kind of touched on earlier, where, the states were trying to pass a bill that was going to allow pass-through entities to deduct property taxes in excess of the $10,000 limit that individuals have. And that got vetoed, but now it looks like, at least, like I said, with this most recent version of the bill, they're increasing the $10,000 limit that's allowed on Schedule A to $80,000. But with that being said, that's going to sunset back in 2031. So you'd be able to take $80,000 on your Schedule A, if you paid property and state income taxes up to that amount. But in 2031, it's going to go back to that $10,000 limit. So I think the biggest piece of this is just we've got to kind of keep an eye on it and staying in front of it and kind of looking at your situation and planning is going to be extremely crucial, because we've got obviously a lot of acts, a lot of provisions with the CARES Act, the American Rescue Act, the Infrastructure Act. Some of them have already passed, and we can look into benefits and implications there, and then others we're kind of still having to keep an eye on as the year comes to a close here. So we just want to be on top of what we can, and then be planning for the bills that are going to come. Basically be ready to hit the ground running for when those bills, if and when they do pass, we can kind of start getting, planning outlook together and keep an eye on things. So, obviously the ERC and the PPP impact are huge, and that's going to be something else we need to be reviewing. So With that being said, Ken, if you have anything else, our emails are obviously there. If you have any questions, feel free to reach out or give us a call. I know there's obviously a lot of material we tried to get through here. So,
Yep, the rules are always changing, so it's important to have somebody you can contact, and that's what we're here for. So thank you for attending today's seminar, and if there's no questions.
I'm not seeing any in there, Ken.
I'm not seeing any either. So I guess we can wrap it up.
All right, sounds good. Thank you, everyone.
Thank you.